So have you all got your groups with the members name and all?
Ma'am, I have a query regarding this. Like, will there be separate groups, or we need to form separate groups with them? How will things happen?
Please be louder. I cannot hear you. Shoham.
Ma'am, I'm asking that, like, what exactly we'll be doing? Like, do we need to form our
Yeah,
separate
so
groups?
this is that is what I will tell you. That is whenever there will be assignment in the class. So I will just the way I do na, I time to time I ask questions. I ask you all to answer. So I will see that which group, I mean who are answering and which group they are belonging. So I will put the class first participation marks accordingly. Number one, number two, whatever assignments, quizzes, and whatever will happen, that will happen group wise. Now individual questions, individual quiz, that we cannot do it group wise. That is fine. But whatever participation and projects and I mean there are some kind of submissions, those you need to do group wise. Okay, I will let you know once, I mean I will do those assignments. I will let you know. It is not that I mean suddenly I mean anytime I will evaluate you and then you will come to know later on. I will let you know.
Okay.
Okay. So during the lecture classes, there will be no evaluation. So don't worry about that during the lecture sessions. Okay. But I mean, until and unless I am reaching a position that I can test you, it is not possible to, I mean, give any assignment or to do any kind of exercise, class exercise. So till that time, it will not be evaluated. So that you need not to worry. Okay, so now this thing, this question, who wants to answer? Now, first of all, why smaller business, targeting smaller business is going to boost revenue and profit? Why it is so? And then whether the decision will be right or wrong. So where it will be affect. I mean, these are the qualitative decisions and qualitative judgments, right? So you need to again, whatever decision you are going to take or whatever performance you are making, maybe everything is qualitative. You have got a very good order, you have made a very good deal with your supplier, with your customer, you have got a very growth opportunity, investment opportunity, I mean a good fund you have found that you can raise in that way. There's an opportunity to take whatever may be the decisions or whatever may be the situation. I mean, everything needs to be quantified and needs to be converted into numbers, and you need to see that where you stand and where you will go after taking this decision. What is the transaction and what is the effect of that on what accounts? You have 4 accounts, right? Asset, liability, equity, expenses, and revenue. Now, in the liability, I mean both the equity and the liability. Okay, because equity is also liability towards owners. So in that sense, it is liability also. So now who wants to answer? Raise your hand. Why targeting smaller business is going to boost the revenue and profit, and what is the bad about it? What is the good about it? Yes, Kshitij. Kshitij, you answer please.
Yes, ma'am. So by targeting smaller businesses, I think with a low customer acquisition cost, the sales manager can actually target a business with a lot of other customers. So indirectly, they will be serving the customers and the users of the smaller business with the lower customer acquisition cost. So at a low cost, the boost in revenue and profits would be really good.
What is
So that is the
customer
point.
acquisition cost? So when you are making something, I mean, please, I mean, make it clear for your friends only, okay? Because many of your friends are not aware and not used to this, terms you are using.
So
So, I mean, we use this
basically,
kind of terms now. As a student of finance, you need to pinpoint that what exactly you mean by this cost. What comes under that?
okay, sure. So basically, when you're directly targeting, hello, ma'am, I'm getting some
Yes,
echo.
yes. Okay, just wait a minute.
Yeah, so when you're targeting a lot of people and directly users, there is a customer acquisition cost involved. So there might be marketing cost, and you might have to, put up online ads and stuff like that, which adds a lot of cost to the balance sheet. But when you're directly targeting smaller businesses, you might not need that direct user acquisition cost because you'll be targeting a business. So you'll be talking to the business itself. And since you'll be serving the business, the customer acquisition cost which is involved is for that business itself because the users will be for of that business. So you are not directly targeting the users, you are targeting another small business. So the acquisition cost with respect to the with respect to advertisements and stuff is reduced in this aspect.
Anything else? Anything
So
else? Yes, Kshitij, thank you. Yes, Kshitij, you want to add something?
no, man, that was it.
Okay. Anyone else who can, I mean, who wants to say something about why smaller business or as customers may boost the revenue and profit? Yes, Divya.
And maybe economies of scale could be involved here because there are a lot of small businesses and MSMEs in our country or maybe wherever it is happening. So there is a large customer base that we can target, and then it would help us because we are going to get a lot of customers. So that's why small businesses are important, I believe.
So, I mean, both of you are talking about you can increase your volume, right? Volume wise, you
Yes,
can
ma'am.
do better. Are you trying to say? Because see, I mean, when you are talking about revenue, so when you are talking about profit, so that profit, how you can boost your profit? There are two ways, right? Either to increase your revenue or to decrease your cost. So when you are taking any decision, your decision is, I need to boost my profit. So this decision is going to reduce my cost or it is going to increase my revenue. Now, Kshitij talked about decrease of customer acquisition cost. By that, he meant that the marketing and these things. And you are talking about increasing the sales, right?
Volumes, yes.
And that too. So now, when we are talking about revenue, again, it has two components. One is price per volume per unit, and one is the total volume. So you are trying to say we can reach more customers, right?
Yes,
So
ma'am.
volume wise, it will increase. So these are the reasons for going for smaller business as customers. That is going to boost the revenue. So anyone else want to add to it? If not, then I mean, if somebody wants to add to it, then tell me. Otherwise, tell me what is the problem in that.
Ma'am, what you
Ma'am,
just
less reliability.
Okay, reliability is a problem, but the point is, I want the answer that how it is going to reflect in your financial statement. Reliability, how it is going to reflect. Where
Our
it will.
investment may not return.
Mm-hmm.
Yes, ma'am. So our investment may not return. So,
Your
uh,
investment, where you are investing.
like
We
when
are
we
talking
target,
about that it may boost the revenue and profit, but it may happen otherwise also, right? So, what is if it happens like it is going to boost your revenue and profit, that is good. But what is the bad? If it does not, happen, then so you are telling that your investment may not give you return. So where is the investment and where is the return here?
So when we'd be targeting small businesses,
Mm-hmm.
then we'd be interacting with the larger customer base of those small businesses.
Mm-hmm.
But that would not be a direct interaction, right?
Okay.
It would be through that small business, and a small business need not be very reliable in getting us the returns. They may shut down, or they may be subject to various conditions, such as, for example, the pandemic right now. But larger big businesses are more stable.
Your
And
smaller business is your customer, mind it, okay? Your smaller business is your customer. So you are not making your investment in your customers, right? We do not make investments in our customers. It is not that for reaching out the customers, you are using small business as a path. Here it is mentioned targeting smaller business as customers. So maybe it is a B2B company where you are targeting your smaller businesses or your customers. Okay. Say for example, you are a professional, you are an audit firm, say. You are giving service both to the big firms or to the small businesses. So small business is your customer, right? So think that way and then tell me what is the bad about it. What is the problem if I target? So what
And
is the good about
reliability.
that?
What I was saying earlier, the volumes will increase, but the reliability of getting that money back will decrease, because small businesses, as he was saying, may run out of business or may have cash crunch, and will have to give them some, like, let's say 6 months to repay us, and it is possible that they don't repay the money or they go out of business before paying our money, and then it will be
Fine. So
in.
where it is going to hit?
Liabilities.
Yes, ma'am.
Liability. What is that liability called?
debt.
Yes.
Bad debt.
Bad debt. Yes. So that means if you target the customers who is weak, maybe you can get the business very easy. Maybe you can get the customer very easy. Okay, but the problem is maybe you will not get, you cannot collect the money. They may not pay you because of their weakness. They are not strong enough. Capacity wise, they are not. It is not very guaranteed that you are going to get. Actual case, there are many big players also nowadays who are actually the big defaulters that all of us know, the scams that are going on. But the point is, generally small business, the MSMEs, whenever some downturn happens, you do not know, how it is going to affect them, and if they are affected, so the whole supply chain is going to be affected, right? So the problem is, it may, targeting the customer acquisition cost or whatever, those may be very low. You can get a very good number of customers maybe, but at the same time, the risk is higher because of the credibility and the reliability of them. Okay. So where it is going to hit, credit risk is higher than the larger customers. Accounts receivable may rise. Bad debt allowance may increase, which reduces profit. As I said, that bad debt allowance, bad debt reserve, provision for bad debt, all these are similar terms. Okay. And accounts receivable may rise. Maybe you are not considering it as your bad debt reserve, but the problem is your receivables. It may rise. So that means your cash is getting blocked into receivables. So till the time it is not getting released, you are not getting the cash, you are not able to use it. You cannot buy it, your materials directly, you cannot pay it to your suppliers. So there's a working capital gap. There is a working capital problem that arises, right? Okay. So why, we are discussing, so the last time we have discussed one example where payables have increased. Here we have discussed one problem where receivables may rise. Okay, so all these, which financial statements they are affecting? They are affecting the balance sheet. If we see, so this payables increasing means there is an impact on the balance sheet. Receivables may rise means there is an impact on the balance sheet. So not necessarily only the expenses and revenues. Expenses and revenues. Only this thing should be our matter of concern. Okay, how our balance sheet is. I mean, what is the balance sheet status? You can see that the 2 years, 3 years balance sheet trend, and you yourself can decide that whether the company is going in a wrong direction or in a right direction. Where is the problem? Is it that the receivables are going too high? Only looking at revenues and expenses is not going to give you the answer. You need to analyze each and every item of your balance sheet, cash flow statement and income statement, and then you need to make a conclusion that what exactly is the problem, where exactly is the problem. Okay, so that is the point of discussing these examples. Now the next is this one. Then again, please raise your hand. What are the goods and bads about it? Yes, Divyam?
Ma'am, goods and bads are debatable here, I think, because
Yes.
the amount of money that we will interest, that is buying a computer system here, what what amount of return monetarily we will get out of it, first we have to analyze that. So
Hmm.
so it could be a good or bad, but without the data, how will we conclude like it's a good or a bad
No,
statement?
that
Because
you only, I mean, it is not that, I mean, it is I mean, long case study, I'm giving you all the information. You just tell me if this happens, then it is good. If this does not happen, then it is not good. I mean, you only explain me.
okay, so if the time to do something reduces drastically, if time to serve one customer, even if that decreases, let's say 50%, so we could encounter more customers and
Mm-hmm.
the volumes will increase and hence the revenue will increase. But what cost are we incurring because of buying a new computer and how
Mm-hmm.
long we have to
Exactly.
repay it?
So whenever you
So
are taking any decision, there's a cost benefit analysis, right? Yeah. So
yes,
what are the costs involved? Yes.
yes, so we have to the buying of new computer will lead to maybe generation of new we have to get an internet service as well. So new cost has been incurred, and
Mm-hmm.
so we have to analyze all these aspects, and it might be good if we can serve more customers or maybe our
Okay,
product.
fine. So,
Yeah,
okay, fine. So that means you are telling that if additional expenses we need to incur, then you need to see that how much revenue it is going to, I mean, generate, right?
yes, ma'am.
So depending on that only we can decide, right? Anything, any other factors that we need to consider? Is there are many hands raised. One is Lakshyata. Yeah, you
So ma'am,
tell me
I
what you
think
want
in
to.
the
Yeah.
direction even we have boosted our productivity, but that necessarily does not mean that we have sold all of that which we have generated extra. So
Mm-hmm.
maybe we have generated extra things to sell, but we have not sold them because of probably not good marketing expenses are there and proper advertisement is not
Okay,
there.
so
So
that means as you are telling that, I mean, as Divyam also was telling, I mean, there are maybe a lot of additional expenses, right?
additional expenses as well as we have generated only products to sell, but we have not actually sold them. So we cannot
Yeah.
comment on profitability.
Okay. Okay. Anything else? I mean, with this decision, what are the other things that I mean will should come in our mind? And I mean, um,
Ma'am, can I?
yes, yes. Who's
Yes.
Akash? Yes,
Yes, ma'am.
Akash.
Ma'am, I believe that the most important thing would be the investment, where we are getting it from, whether it's from our owners or retained earnings, or whether it's coming from debt. That
Mm-hmm.
might play a huge role in taking up the decision.
Very good. Hmm. So what is the problem? So for example, it is if it is from retained earning, is there any problem? If it is from debt, so is there any problem? Just try to think. and you answer for everyone. Okay, all of, I mean, everyone is listening also. If they want to say something, I mean, in support or against that, I mean, just tell everyone that what is the, I mean, what is the problem? Is there any problem? I mean, is there any difference if you're raising from, if you're taking from retained earnings or if you're taking a loan? What is the
Yeah,
point to consider? Yeah.
I think, ma'am, if we are going for some like debt or something like that, then or loans, it depends. We are not sure about the decision whether it will increase, boost our productivity or profitability. We cannot be like assured about each and everything.
Why? Then why? Why if I am taking loan, then it is not going to assure my profitability? Why?
We cannot be sure. Depends now whether market would be like in favorable or not. The conditions might affect after some time, and the investment we have made might not be like.
Yes, so you are not sure that the loan, that the money you have raised in terms of loan, whether it is going to be used in such a way that you are going to get profit. That will depend on the market. That you are trying to say, right?
Yes, ma'am. And after that, whether our profits turn out to be good or bad, we have to repay that. And I'm not sure if it's turned out to be bad, then we are not able to repay, and that might
So
affect
that
our
means
company.
by taking loan, you are taking a risky proposition. So now
Yes.
I'm going to the next job. I think job Stephen James. There's a, I mean, it is a so long name. What you call yourself?
Job, ma'am.
Job. Okay. So job, you tell us that. I mean, what you want to say about this?
Ma'am, I think we should also take time into consideration.
Mm-hmm.
Is it profitable or not? It might not be profitable in the short term, but in the
Mm-hmm.
long term, it might generate revenue like that.
Mm.
So that is all.
Okay. And Sanyam, you are the last one, I think. No, Sanyam. No, Sanyam and
Uh,
Shitij.
Ma'am, one thing is the one-time investment, which is the new computer system. But the
Mm-hmm.
other expenses, which includes a regular investment, which is like maintenance
Mm.
of that computer system,
Mm-hmm. Mm.
additional IT guys, which we need to hire for the maintenance,
Mm.
the Wi-Fi. So that are the
So
other
just a
expenses.
minute, Sanim. I'm interrupting you. I just want to tell everyone that when the just look at the statement. Uh, the decision is to buy a new computer system to boost productivity and hence profitability. The is the decision is good or bad? Okay. So now it is not that I am asking that whether it is going to boost the profitability or not. The question is not that. The question is you are buying the computer to
Yes,
boost productivity and profitability. Now the decision is good or not. Okay, then you answer. Yes, please then. Continue.
So taking the decision, we have to do this analysis. So
Hmm.
always, yes, doing the investment is always a good decision,
Mm-hmm.
but what will be the cost benefit and the uh,
Yes.
so that we have to
Okay.
analyze. After that, we can say which type of decision will be good.
Okay, Sanya. Okay. Thank you. Then Shitij, you are the last one. I mean, just try.
Ma'am, it's just one of the qualitative factors, which is whether the ability of the team and the kind of team that we are dealing with
Mm-hmm.
can use the new computer system. So when the things get upgraded, the employees might face difficulty in using the systems, and that might lead to lesser
I mean,
productivity.
I understand Shitij, but I want it from a, I mean, even that is the problem. Say, for example, whether the people you have they can use it or not. That is the point. I mean, whether you have that skilled employee, or if it
Yeah.
is not, then if you need to hire one skilled employee, then what is the consequence that you want to say, right? So what is the ultimate reflection in your financial statement? So as a student of this class, I always want the answers from a, not from a qualitative perspective. Maybe there's a qualitative, every numbers have behind that there are qualitative issues, but you need to convert it into say this, that ma'am, it is going to I mean, impact on my liability, it has an impact on my revenue, it has an impact on my expenses. You need to, I mean, tell me that where it is going to impact, which number,
It can
which
prove out to be
statement?
it can prove out to be a bad decision and lead to a reduced revenue due to lesser productivity.
Okay, so that means what are the points that have come up? If I summarize, then it may that when I'm buying a computer system, how it is going to match with the capability already I have in my business that I need to check, right? Then the next is what are the additional expenses I need to make because of this. Now there's a kind of employee cost, maybe they need to be given more training. So there are expenses side. Again, if something, some maintenance cost I need to make, expenses side. Now, one thing out of, I mean, all of you, among all of you, what Akash has raised that there is another issue he has pointed. That is the where from I am going to the buy the computer. So that's why I again told you that the question is not that whether it is going to boost the profit or not. The question is whether decision is good or not. So that means when I'm taking the decision of buying something or investing in something, where the money will come, that I also think of parallelly. So then Akash told that the where from the money I will get. That is another important point, but which is very valid point. Even if it is going to boost the profit, where from it will come? So now the question comes whether it is from what he said, whether it is going to be from the retained earnings, that is my own generated profit, or from the debt. So then I asked that what is the problem in between among these two alternatives? But there I think Akash could not make it very clear. He said that there might be some impact on the profitability. So why there is an impact on the profitability and why it is very risky? Now, if the company fails, he said one thing, which is that the company may not, may, I mean, not be able to repay the debt. That is one thing. So if the company is taking debt, think about it. So it is a loan, right? Where it will go in your balance sheet. If the company is not able to make repay the debt, where it will go? Again in your balance sheet, right? So balance sheet loan will be reduced if you repay it, and if it stays there only, the balance will be as it is. But there is no impact in your income statement. There's no impact in your expenses or revenue. But still, Akash said that there is an impact in your profitability. Why so? That if you are using your own profit, then it is fine. But if you are taking loan, then you need to bear an interest. An interest, where interest goes, interest is an expense. Interest is a finance cost. It goes to your income statement and it reduces the profit. So if you think of taking loan for making an investment decision, at the same time, you need to think that you need to bear a interest cost. And if there is an additional interest cost, your profit may rise because of your usage of this new machinery, new instrument that you are going to use. Your productivity will be higher. You will go for more volume of sales. But is it enough? Is it assured? Is it guaranteed that it is going to compensate your additional interest cost what you are making because of taking loan, which will be used for making this investment? Okay, so this is what decision? This is your capital structure, your financing decision. So one decision, buying a computer, is your investment decision. Decision to train your employees, it is your operating decision. And decision to raising loan or using your own retained earnings, this is your financing decision. So go to any annual report, any cash flow statement, and go to your cash flow statement activities. You will find there are three main activities. One is operating activity, one is investment activity, one is financing activity. So without these three activities, there are no other activities in the business that you can quantify. So whenever there is a decision, you need to understand whether it is going to impact my operating profit, operating cash flow. It is going to impact, I mean, my investment decisions, how the investment activity is going to impact the performance, and what will be my finance cost. What are the financing decisions, I mean, I need to take for, supporting my investment decision or for continuing my operating decisions. Okay. So now, what are the risks involved? So if the company, as I repeatedly tell you, because why I repeat these things, when you are going to analyze the company, it is going to help you. So if my company is in a good, very good position, it has enough, cash backup. It has enough liquidity. It is making profit over the years, so it can afford to have, and it is the debt already in the capital structure, the debt equity ratio. You may find that the debt is not very high. So that means what? That means even if I take more debt, I am not in a very risky situation, because if something happens, I have that profit, I have that cash backup, I can afford, I can pay the loan, I can, there will be no issue with it, right? But if it is already over leveraged, it is already a high debt it has in its capital structure, then you need to think twice that whether going for more debt, will it be a good or will it be bad? Because if I go for more debt, then it may be risky. Huh? Because as I told that if you are making profit, you may think of distributing your profit among the equity shareholders as dividends, or you may think of retaining the profit in a business. But if you have debt, but debt does not, consider whether you are making profit or whether you are making loss. You continuously need to meet your debt obligations, your interest obligations and all. Okay, so these are the very related decisions. Even if it is going to boost our productivity, profitability, how to fund it? Is it an over leveraged company with high debt load? So these are the matter of things, matter of concern. Okay. So how to assess the company? Is the company profitable? Always we only look for that, right? Only look at that, whether the company is profitable or not. As a very beginner, you will always try to think that whether it is going to increase my revenue or it is going to increase my cost. But accounting is not all about only expenses and revenue. Only the profitability does not matter. It also talks about the liquidity. It also talks about the risk. Okay, is the company solvent? The company has solvency. That is, the asset is more than the liability. Asset is sufficient to cover up the liability. Here the liability means the loans, liability towards the debt providers. Because otherwise, asset and liability plus equity side should always match. Asset can never be the higher than the liability and equity. Can the company pay its bills? So current asset status, your working capital status, okay, that is very important. Has owner's equity been growing over time? So this is your ultimate objective, okay? What is the source? Retained earnings or capital contribution? So this should be, so here what, as an investor, you will find that there are many companies. I told that in the new ventures, they are continuously making losses. Even the unicorns, they are continuously making losses, but still they have a high value, right, in the business. So what is the reason for that? Maybe the investors who are investing in that, they do not have a very long term, they are not long term oriented. Okay, a venture investor never invest in a startup to stay for lifetime of the venture. No, they only come and they may stay for say 5 to 6 years. Their plan is like that. And what they do after 5 to 6 years, it is not that by generating profit only they will get their return. They want to see that whether the company is growing enough, the company is growing to its full potential, it has further scope of growth, it has that kind of, product, team, technology, that capacity they have, that vision they have or not, so that at the end of 5 years, the valuation of the business go high. And then who is going to buy it from the investors, from the VCs, or if the company is going for IPO, then also it is a kind of selling. So then they will get the value from the market, they will get the value from the buyer. It is not that from the profit only they will get the return. It is they are selling, they are going to sell their stake and somebody else is going to buy the stake. Again, they will give the money based on what? Not maybe based on the profit. So based on what? Maybe based on, again, the future potential at that point of time of that particular venture. Okay. So a company, it is not that always they look for profit, but ultimately who are the long-term investors or the business owners themselves, want to who are setting up a business for staying there. Some people start their ventures with a vision that they're not going to stay for the lifetime, right? They think that they have developed some kind of technology, they will go for a startup, and even if it doesn't work, maybe they are not very efficient in running a business, but they are very good in technology, they're very good in product development, so they are going to exit at the point at certain point of time in future. Okay, so I'm talking about the long-term investors or the long-term founders who are going to stay in the company for a long period of time. So what is their objective? It is not that they are only just going to boost their revenue. Ultimately, what you need to do is make a profit. Now, why it is making a profit? Why it is making profit? And it is not only that only 1 year, a single year I am going to make a profit and my job is done. Because see, whenever you are going to raise money for any kind of investment or operating decision, if you're going to raise money from either from your equity holders or from your debt holders, the problem is if you are increasing your debt, it is becoming more risky. If you are increasing your investors, you are raising the money from your investors, then you are diluting your stake. You have less control in the company, right? So both are not a very desirable decision, right? That you are going to desire that, okay, I'm going to dilute my stake or I'm going to make my venture a very risky one. Yes, that you will never want, right? So what is the best thing? If you can use your own generated fund for further investment or so, that is when we say that the growth is sustainable. So when you need not to depend on any outsiders for raising fund, you can use your own generated fund for any kind of investment or operating decision. Then what growth it is called? It is called sustainable growth. So maybe the growth rate is lower than your growth rate which you can assume by taking money from outsiders. Maybe the growth rate is lower, but that growth rate is called sustainable growth because that growth is going to sustain. It is based on your own generated profit. Okay, so now this profit, then each and every year you are going to accumulate it. You are making profit, you are adding it to your retained earnings in your balance sheet. Next year you already have a retained earnings balance, again you have made profit, and again you are adding it to your retained earnings. So this way your retained earnings will grow, and your retained earnings only is going to support your investments, right? So has the owner's equity been growing over time? That is a very good indicator of whether the business growth is going to be sustainable or not. So as an investor, as a debt provider, as a banker, you will also do an analysis of the financial statements of the ventures, right? And this will be, it is going to give you confidence that yes, the business is growing, and not only growing revenue top line wise, but bottom line also it is growing. That means in future the business is not becoming very risky. It is not that even as an investor, when you see that there are many other investments, whenever there is a kind of decision the company has made, they have raised fund, they have gone for loan, and they do not have their own generated retained earnings over the period. So what they will get, what signal they will get, that the company does not build up have not built up the capacity, right? So always it depends on others, and based on that it is competing with their customer, with their competitors. Based on that they are boosting their revenues. So it is not so, right? So always you need to see that whether the own generated funds are growing or not. Okay, so that's why income statement, it is written here that it is for inexperienced people. So before attending this class, you only think that there are income statement, that is the revenue and expenses, that only matters, and I need to look for that. But balance sheet, what kind of important indicators balance sheet provides us? It talks about the capital structure, the riskiness of the venture. It talks about the working capital position, the current asset, current liability, the cash position. It talks about the liquidity. It talks about the solvency, which are very, very important indicator. If you are planning to run your business smoothly, if you are planning to raise your funds, everybody will look at those indicators, and you yourself will also look at those indicators. Okay. Uh, so what is the difference between income statement and balance sheet? It is very easy to understand. As a student, income statement affect the balance sheet much where individual grades affect your CGPA. Why? Because balance sheet is a cumulative thing and income statement is a one time, right? Balance sheet is a state of the business over a time period. What is the current state, taking everything from the inception. An income statement is for a particular accounting period. What is the performance of the company? Okay. So these are the same basics, and how equity and asset and equity side matches. Equity is equal to what it owns to what it owes. Okay. So that means, again, what is, say, see, just think about the balance sheet. One side is asset side, other side is equity plus liability. Remember, A equal to L plus E. So now if you keep the E in one side, then the other side is A minus L, right? So A is the asset, what the company owns. Okay. And L is the liability to the debt providers. Now the rest is what? Rest is equity. So that equity is the net worth of your company. When we say that what is the net worth of the company, it is asset minus liability. That is the equity. That is the net worth of the company. So all your assets, when it is more than liability, then you are in a solvent. It is called that you are solvent. Okay. Now we will discuss something. So this kind of exercise, whenever we will do it group wise, right? Not today. From next time onward, maybe next class we will do one assignment. So next time onward we will do this kind of exercise in group wise. Okay. So here, any of you will raise your hand and tell me that what is this asset, liability, equity. These are all the balance sheet items, and what kind of asset, liability, equity these are. Okay. Equipment, please raise your hand. These are just to check your understanding, and if anybody is not, again it is clear, then please tell me. Okay, I will make it clear. Okay, Arpit.
Ma'am, equity is an asset. Equipment is
Which
an asset.
asset? What kind of asset?
Fixed asset.
Fixed asset. Okay. Then retained earnings. Abhijit. Abhijit, you have raised your hand. Tell me retained earnings.
Asset,
What it is? Hmm?
current asset, asset,
Asset. Okay, Rishabh.
Yes, ma'am.
Tell me retained earnings.
Retained earnings should be equity.
Equity. So Abhijit, you understand why retained earnings is equity? Rishabh, can you explain why retained earnings is equity? Why it is not
Uh,
asset?
because retained earnings is what is the part of the money which goes to the shareholders, like which is owned by the shareholders. It is
Mm-hmm.
after paying off everything.
So
So
what is the principle? Why it is not considering? The business has generated it, right?
yes,
So you have generated it. Why it is not an asset? Whose asset it is? It is asset, definitely. Whose asset it is?
the shareholders.
Shareholders.
Shareholders' asset. So why it is not asset to the business? It is shareholders' assets, mean it is business's asset, right? Yes, Rishabh?
No, it is the shareholder. Not the both are different entities.
Both are. So that is the answer, right? So since business, so Abhijit, you understood, since business and shareholders, that is the investors, that is the owners. Owners and business both are separate entity. So this is from the dual entity or separate entity principle. So that's why what is owner's asset is a business's liability towards owners. So it is equity. It will come under equity because liability towards owners means equity. Liability towards others means it is liability. Okay. Is it clear, Abhijit?
Yes, ma'am.
Okay. The next, patent. Yes, Shachi.
Ma'am, it is an intangible asset.
What is the nature of the asset?
It's a long-term asset.
Long-term asset. Long-term asset or fixed asset or non-current asset. Everything is similar, right?
Yes, ma'am.
Okay. Then dividend payable. Other than Rishabh, anyone else? Dividend payable?
Ma'am, liability?
Okay, good. Liability. What kind of liability?
Ma'am, that I don't know.
Okay. Who else?
Current liability.
Who is this, please?
Lakshita.
Lakshita. What is the what liability it is?
Current liability.
Okay, then you please explain why it is current, because somebody said before that he has no idea what liability it is.
Because we have
Why it
to
is
pay it
current?
to the shareholders in the near future only.
Near future. Okay. So what is dividend? Tell me.
Like
Is it
there are
asset
preferred
equity?
shares.
Whether if I say that dividend, what head it will come? Asset equity liability, asset equity liability revenue expenses. What
If
head
we
it
are
will come?
paying the dividend, then it's a liability. But if we are the preferred shareholders, then it will be our asset.
Asset. Whose
Uh,
asset?
like so we pay the
So
dividends
tell
to
me, say for
preferred
example,
shareholders.
dividend, not dividend payable, it is dividend paid, say. Okay, you have paid the dividend. Fine.
Yes, sir. Yes, ma'am.
So now what it is? Asset, equity, liability, revenue, expenses. What it is? Dividend
It's
paid.
already paid, so it's no longer a liability.
Fine. So what it is?
Uh,
It is no longer a current liability. Remember.
it's
Huh?
already paid. Yeah, exactly. It's
So what it
all.
is?
So it's. I'm not so sure if it is expense or not because it's already paid.
So all the expenses what you are, putting as expenses. Okay, say for example, materials purchase. So it is an expense. It is already paid, right? If it is paid in cash. So if a
Yeah.
salary is paid, so where it goes?
So it is an expense. So yes, it will
Okay, so
go
it is an
in.
expense, right? So
Yes.
now anyone else? Dividend is expense or what it is? Who wants to say? Anyone has any? Who wants to counter or argue?
Ma'am, it's an
Nobody?
expense.
Who is that? Please raise your hand, please. I cannot.
I'm challenged.
Shailesh, you are also telling it is expense?
Yes, ma'am.
Anyone else?
Ma'am, what
Dividends
is being
payable.
Mohit, yes, Mohit.
It is reduction in equity.
Reduction in equity, very good. So why it is not, why it is reduction in equity, why it is not expense? Dividend paid?
Because it is retained earning added to shareholders equity, and
Hmm.
we are paying from
No, no,
retained
no, no,
earning.
no. Mohit, just 1 minute. It is not retained earnings, right?
No, no, ma'am.
No, it is not retained earning. Okay, so what it is? Why
It
it will
is
go as
deducted
a
from
reduction of equity? Hmm?
because it is percentage of profit, whatever company had that year.
So Mohit has tried to answer it. Everyone, please repeatedly, I will, give this kind of examples and repeatedly I will discuss in the class. Okay, so be very clear about all the items. Dividend paid, when it is paid, in that sense, what Lakshita was telling that it is expense, it is expensed, it is paid, but that doesn't mean it will come under the head expense. Why? Because we do not count dividend expense to calculate our net profit. Dividend does not come before net profit to calculate, just like interest. Interest comes before net profit. By deducting interest only, what profit we get, that is net profit. Okay? But dividend we does not consider for determining our net profit. It is not an expense, it is appropriation of profit. So it is not expense, it is appropriation of profit. What we do, we put the revenues, then we deduct the expenses, we get the operating profit. From that, we deduct interest, which has nothing to do with the operations. Interest means interest on debt. So it is your finance cost. So after deducting interest, we get net profit before tax or earnings before tax, which is PBT or EBT. After from that we deduct tax and we get the net profit, which is popularly called profit after tax, PAT or EAT, earnings after tax. Okay. Now dividend is the appropriation of that net profit. That means we need to decide whether we are going to keep the entire amount of profit as retained earnings, or a part of it we are going to distribute it as dividend, or we will distribute all the profit as dividend. So dividend is an appropriation of profit. But when the dividend we are not paying, it is payable. So it is our liability towards whom? Not towards debt holders, but towards equity holders. That's why Mohit told that it is deduction from equity. Okay, so in your balance sheet, it will be deducted as your equity. In yours, there is another statement, the statement of shareholders' equity. There we will show the beginning or amount of retained earnings, the amount of net profit earned during the year, then deduction of dividend, and then the ending balance of retained earnings, and that will be shown in your balance sheet equity side. So that's why it is a deduction from equity. Okay. Okay, then prepaid expense, Shailesh.
Yes, ma'am.
Yes, so prepaid expense.
Ma'am, it's an asset.
Prepaid expense is an asset. Okay. Why? What kind of asset, first of all?
Ma'am, it's in current asset.
Okay, why? Why it is an asset? Why it is a current asset? What do we mean by that? Give an example.
Ma'am, we can take the example of, let's suppose, ma'am, whatever the expense that is there for the company, uh, that has been already paid earlier, ma'am, before the final date of the, ma'am, before the, what I can say, ma'am, before the date we have to pay the expense. We have paid that expense prior to that particular date. So for that, whatever the
You have
service,
paid before 31st March. If 31st March is the ending date of the financial year, you have paid it before 31st March,
yeah,
right?
and whatever, yes, ma'am. And
But
so
why
whatever,
it is not your expense then? You have paid it, right? Your cash has gone out. So why it is not expense then?
ma'am, but whatever the services that we are going to get in, we have not received as services. So services we are
Yes.
going.
So when you are going to get it after 31st March, but the expenses have made before 31st March. So advance you have made. So on 31st March, you need to prepare your financial statement. So where you are putting it? You cannot put it in your expense because because of which principle you followed, Shailesh, for this recording of this transaction, which principle? Anyone else? Which principle? There are few principles, there are few conventions I have discussed in the class, right? Type separate entities, somebody said.
Accrual.
Tell me.
Accrual.
One is separate entity concept, dual entity concept. Here, this is the expenses have been made this year before 31st March, and the service I am yet to get, that is after 31st March I will receive. So I cannot put it in my expense side of the income statement. I need to put it as my asset, in my current asset, in my balance sheet, because I'm going to get the service in very recent future, before 1 year. And
And you'll add it in the and we'll add it into the assets one and subtract it from the cash balance.
true, but what is the principle? It is called the matching principle. Okay.
Yes,
Just
ma'am.
remember, this is a matching principle. My revenue should always match with my expenses. So here I am spending now, but the service I will get, it will be delivered next accounting period. So how, because of the matching principle, how can I put it in my income statement? It is not going to match with my service, right? So that's why it will come as a prepaid expense. I have already paid, but I am yet to get the service or product, whatever. So I am owning, I have an ownership on that. So that's why I means the business always. When I keep telling I means here I am business. So business has ownership on that service that is yet to get. So that's why it will come as an asset side, current asset side. Okay. Okay, let me, my laptop charge is going to get over very soon. Charge is very low. So let me take your attendance. And this kind of exercise next time onward, whenever I will do it, group wise. Okay, so whoever will be asking, whoever will be answering, he will be answering as a representative of his group, and the groups will be evaluated. So please respond accordingly, because it is not possible for me to count each and everyone's response.